right, welcome back to another episode of Inside the Deal Room. My name is Gabe Bowling, and in today's episode, we have an incredible guest speaker, Axel Ragnarsson, up from Boston, Massachusetts. Welcome to Tampa, and thank you for being here, Axel.
Thanks for having me.
All right, so the way that I always typically start these things out is I always have people here, they're in different phases of their real estate career. Some people are in year 1, year 2, year 3, year 5, year 10, and year 30. Today, where would you say you're at? And then I guess introduce yourself to where you're at today. And then I want to kind of pull back the curtain on how in the world you got there.
Yeah. So technically speaking, I guess I've been a full-time real estate investor since 2016. So we're coming up on 9 years here, but I will say that the first 3-4 years was, I don't know, a lot of stumbling around in the dark. So I would say probably year 5 or so is how I would describe where I'm at in our journey as it relates to like really pouring gas on the fire and actually really building a business. And to provide some context around where we're at now. So like you mentioned, I live in Boston. We buy throughout New Hampshire and then New England at large. Although we do have, we did a few deals out of Florida. We still own one over in Bartow, Florida. But long story short, 2016 to 2020 was me just doing deals with my own money, a lot of debt, a lot of direct to seller, buying stuff that was 2 to 10 units in size, but a lot of hard money, private money, stuff like that, creative financing. Built a portfolio of 80, 90 doors or so. And then 2020, COVID hit. And then when nobody was doing deals, I kind of took a step back because we had, I had a chance to kind of pick my head up and was asking myself at the time, is this really the road that you want to keep going on? I was doing smaller deals, no partners. Like it's going to be hard to build a portfolio of size doing that, or any real business. And it was around that time I started learning about, syndication and structuring deals, working with joint venture partners and basically how you could do deals without your own dough or without just using a ton of debt, which is what I was doing, was like leveraging every deal to the max just to reduce cash out of pocket. So between 2020 and 21, 22, started doing some deals with some LP capital, but it was on a very small scale where maybe we're raising a few $100,000, $400,000 for smaller 10, 15 unit types of deals. Yeah. And then towards the end of 21 and really into 2022 is when we really built out the platform in terms of, started doing some like email marketing, started becoming really comfortable with the process of actually raising equity, started to understand exactly what we needed to find from a deal standpoint to make it work with investors. And that's now been the last, call it, 2.5, almost 3 years now, has been pouring gas on that fire. A big component of what we do is direct to seller prospecting marketing to find deals. So just pouring gas on that fire, finding a lot of deals, pouring gas on the capital raising fire and starting to raise more money, both from new investors and then our existing folks. And we've just been buying more deals. And along the way too, we brought our property management in-house, and we have basically under a separately branded company up in New Hampshire. We manage all of our own buildings as well as third party, and that business manages about 750 units right now, about 50-50 split between what I'm involved in and then what's third party. But the last 3 years, we bought about 350, 360 units. Wow. We've since sold a little bit of that. Since starting, in real estate back in 2016 or so, in the last 9 years, bought 550, 600 units or so. And really now the business model is I still buy deals myself because my whole long-term North Star is a portfolio of real estate that I personally own that nobody can tell me what to do with and that I don't have to report to investors on. Yeah. So I still do that, but those deals are 5 to 10, 5 to 15 units. Yeah. And then we're out there looking for stuff that's 30 to 70 doors, $3 million to $10 million in purchase price. And those are the deals that we're going in raising investor equity on right now. And that's what the business looks like today.
Yeah. Well, thank you for that. So what I hear is solopreneur, building out your real estate portfolio, creating some financial income or the pops that you're probably getting from doing the flips. And then over the last 3 years, you're really focused on building it sounds like a real firm, like an investment firm. Yep. Yeah. It was at first the construction piece, the management side, and then finding the deal sourcing. We're going to dig into the off-market approach. And now the last couple of years, it's been investor relations, actually raising money from investors and trying to focus on the scale under the portfolio.
Yeah, I think the last couple of years, I think you hit the nail on the head. Like the constraint in the business became money, right? It wasn't deals, it was money. So that's been the last 2 years is me solving for that constraint, which is just in-person networking and asking for referrals to new investors from our existing investors, pouring gas on, the content stuff we do, which is like the Instagram and the podcast and all of that, bringing in some co-GPs or JV partners who are going out there and actually raising the money for our deals. So maybe I'm raising half, and then I have a partner who's raising half, and that allows us to keep doing deals without having deals that we can't fund. So that's really been the last couple of years, and then building out like the infrastructure of what has become like a real business, which is like I have a full-time acquisitions guy now, and we're about to hire a full-time operations guy, so I can stop spending so much time on asset management and spend a little bit more time on the capital raising and all of that, and on the content and the stuff that really drives the, you know, the money coming in the door and the deals coming in the door. So really that's been the last couple of years, is turning it from a solo business where it's just a lot of stuff going on at any given point in time to trying to get our arms around a little bit more. And there's a whole bunch of things that come into that. But as you mentioned, right, capital was the big one, at least the last couple of years for it.
Well, everybody runs out of money at some point.
Yes. It's a capital intensive business at the end of the day.
All right. So there's so much to unpack, and hopefully you don't mind going a little bit over 45 to an hour.
I got that.
We have a lot. So I want to kind of bring it back. A lot of people are in the year one or maybe jumping into real estate today. So I want to always start with, what was the first deal and how did you actually get into the business?
So from learning about real estate to first deal was like a year. So let's, that, so oftentimes people don't talk about that, but it was, I was 20, so I was in college. This is 2015. And so without detouring too much into end of high school, early college, my way of making money was I flipped cars. Like that was my hustle to make money, was like buying used cars on Craigslist and selling them. So did fairly well for, I guess, relative to being that age. So I had a couple bucks, 15, 20 grand at the time, to where like I was like, okay, I want to go and do this.
Real money back then.
Real money in college. Oh yeah. Oh, I felt like I was living the dream. But I would say not nearly enough to really get into a deal, assuming you go out there and you just go put like 25% down. And in my market at the time, 2s, 3s, and 4s, and this is Southern New Hampshire, an hour north of Boston. At the time, you're going to spend 300 grand for like a duplex, right? Like that was 450, 500 for 3-4 unit types of deals. So I couldn't like go to a bank and put the money down. That wasn't an option. And also I wasn't financeable because I had no credit. Like I had yet to get like a credit card. So I was like, all right, so I want to do this real estate thing. And I think I learned about it through an Instagram ad or HGTV. I don't even know, but I ended up on, Bigger Pockets, and then starting to listen to podcasts, watching YouTube videos, and just became obsessed with it. So at the time I was like, the only way for me to do a deal is I got to buy a deal at a significantly discounted price. That's going to allow me to go out there and borrow a ton of money. And I had went to some like in-person RIA events in Southern New Hampshire, and, asked a bunch of people like, how do you buy stuff with no money? And they're like, just use a lot of debt, go get hard money or go get private money or something like that. So the first deal I did was I was messaging for rent ads on Craigslist. Just like, hey, I don't want to rent your place, but are you interested in selling? Probably messaged, I don't know, hundreds of owners. And then I finally hit a guy who was like, yeah, I'd be interested in selling. And he had a 3-unit property in my hometown. This is 45 minutes north of Boston in New Hampshire. And I grew up in Southern New Hampshire, and wanted $195 for it. It was 3 units. I thought I was going to be worth like $250. And long story short, I had a private money lender lined up who was going to loan 90% of it, and I was going to fund the rest and construction and all that. So I brought all the money I had to closing and put, some of the renovations on a credit card type of thing. And that deal actually didn't go that well, long story short. I went to go refi it, and all the banks were like, dude, we're not going to lend you any money. You have like no W-2, you have nothing. So the only options I had were like crappy commercial loans from local banks. Long story short, I was like, it doesn't really make sense for me to do this. So I just went to sell it. And I missed a whole bunch of things during DD, just all beginner mistakes, but I sold it and basically broke even on it. Long story short, after all was said and done. But obviously experience being invaluable. So that was deal one. And then it was replicating that strategy for the next, few dozen deals, was finding these small deals direct to seller. Various different approaches, using a lot of debt, buying at a margin in which I could refi out and not have to leave money in the deal and just cycle it into the next one. And every once in a while selling one, so more money was coming back in the business. But
very cool. Well, thank you for sharing that. Most of the time it's either I just scaped by, but I got my learning lessons, which was great enough. I didn't need to make 500 grand on that, as long as I got out of the deal so I can move on to the next one. It didn't kill me. I'm happy there. But hopefully you didn't make the same mistakes that you made in the first and to the second.
Definitely did not.
All right. So you do the first deal, and then what are you doing for income during this period of time? Because what I hear from you is, I do the same thing over and over and over. It's not, I do a 3 unit and then jump up immediately to a 300 unit.
Yeah.
What was the years like in that grind?
Yeah. So really it was like, if we call it February of 2016, which was deal 1, to basically call it end of 2020, it was the same thing over and over and over and over again. And if I were to do one thing differently, it'd be like, go buy the 3, then go buy the 6, then buy a 10, then buy a 15, and start to increase the average deal size, which I wasn't doing. I was just buying the same types of deals over and over and over again. But really the approach at the time was, the first deal I was 21. And then shortly after that, I got my real estate license, because I was like, when I graduate, I can, I didn't know what I was going to do. I was like, maybe I'll go take a job. Maybe I'll get my license though, because it's really easy to do in New Hampshire. And I think it's pretty similar in Florida, right? It was a 40-hour class. I was like, I can just do that.
And you can fail it up to 4 times.
Yeah.
I failed it.
Exactly. I failed it the first time too, and then passed it the second time. But so I got my license, and then I just worked as a real estate agent. I was selling like small multifamilies, and I got linked up with a broker who was like the definition of a guy who had like a little too much business for himself. And I met him at a networking event, and I just started helping him out, and he'd kind of like give me a deal here and there. I'd work with like a buyer. So yeah, I was making 50, 60K a year in commission income, like nothing crazy, but my living costs at the time were nothing. I was living with 4 guys after college, and, I'd spending $1,000 a month maybe. So all of this money that I was saving. And then after that first deal, I broke even, but the subsequent deals I was doing after that, it was the same approach of find killer deal, use as much debt as anyone will give me. Literally. It was just, I would ask everyone around, I was paying 13, 14 points, like 100% leverage.
Yeah.
Which again, that's maybe not an advisable strategy, but being 22, 23 with no downside, it's like, I was like, yeah, of course I'll go do that.
Yeah.
And I was buying great deals. It always came back to like, I was buying $400,000 properties for, 275, 300 grand, all kinds of margin.
Yeah.
So I'd sell some of them, and that was where the real money was coming back in the business. And then, or I'd, refi the ones I thought I'd want to hold a little bit longer.
Yeah.
And then I was working as an agent, and money was coming in doing that. Now, the real inflection point in the business was 2018, where I think I had like 15 units or something, and still working as an agent, a couple years. Well, now I'm like 18 months out of school. And I realized that I was like really no longer lendable. Like the lending piece with banks was becoming the big hurdle. So not a lot of credit history, completely out of whack to income ratio.
Yep.
Even if I was going and getting commercial loans, which is property first, borrower second in terms of how they're underwriting, they're still getting to the point to where they're like, it's just, we're betting a lot on you. Yeah. You're a younger guy. Like you haven't been in this for a while. So the terms that I was being offered were either I wasn't getting offered any term sheets, or the terms were terrible.
Yeah.
And I was like, I might have to just go get a W-2 to kind of make this process a little easier. So I took a job down in Boston, and I moved down to Boston with a few friends of mine. It was a sales job at a, startup down there. It was just whatever, kind of like business development job. And it was really for the W-2. Now, the third day on the job, a guy who got a direct mail piece for me, up in New Hampshire at a 12 unit. And I left me a voicemail at like 8 a.m. while I was in training. Couldn't call him back until 6, 7 p.m. when I got home that night. And I called him back, and he's like, I just took an offer from somebody else. And he told me what the number was. And he just gave this property away to a guy. Like 50% of market value. Like comically, to the point where I was like sitting in my living room with a friend of mine I was living with at the time, going like, I'm just going to go in tomorrow and just quit my job. And I literally did. So the next day I went in and I quit the job, and now I'm down in Boston with a lease. So I'm down there, but that's when, at that time, I was like, I'm not going to do the real estate agent thing anymore, because that's just like, I'm not working for that much money. I'm selling like small, crappy starter homes. Like it's just a total pain in the ass.
Yeah.
I'm going to go all in on the deal sourcing thing, because I was like, this really works. I'm really good at this. I define that as like, you're doing way better at this than everyone who you're competing with. So just go spend all of your time finding the deals. And that's when I started assigning some, I started flipping some, started buying some. And that's when the money really started to come in a more meaningful way.
Yeah.
And then, 18, 19, 20, it was just growing the portfolio, and then got it to a point to where the portfolio was somewhat self-sustaining, right? The cash flow from that was allowing me to reinvest into more deals. My living expenses weren't going up. They were just the same, right? So it was all going back into real estate. And then, 2020 was kind of the inflection point of let's go raise money. And that's where that, kind of pivoted the business into like, let's go do bigger deals and raise some investor equity.
Yeah.
Because it did get to the point to where even if I was finding great deals, like it's still so capital intensive. You buy a value-add multifamily project, there's no money's going out the door for 9 months, 12 months before any of it starts coming back in. And managing my cash with high interest debt on acquisition across a bunch of these deals started to feel a little bit like a house of cards. And I was like, I'd rather give up more of the equity in these deals and run a little bit more of a predictable business.
Got it, man. Well, thank you for answering the questions and expounding on like everything beneath it. I don't think many people do it on a podcast style. They typically stay.
I'm a talker, as you'll probably find.
My wife calls me a professional yapper. It might be bad for the people listening, but hopefully everybody's enjoying it. All right, so I've gotten up to the point of you're in the business and you're repeating what you're doing. You take the sales job. That's funny. Did you always, the deal sourcing, did that just naturally come to you? You're like, okay, well, because I've been flipping cars, I know what a deal is. Are you just a deal maker at heart? And how important has deal sourcing been for you in really developing that skill set? Because it truly is a skill set.
Yeah, it's an interesting question. I think a lot of it is probably just my own personality type. Like I was the kid, like selling like baseball cards on eBay, like using my mom's eBay account. Like I've always kind of had that like gene. Like high school, I used to go buy, sporting equipment and flip that before it was the cars. Like there was never really had a real job. Like I worked at a grocery store for a little bit and quit that because I was like, I'm making more money doing this thing on the Craigslist. So that's always kind of been interesting. I've always like just been doing that, which is a weird way to describe that. And then specific to real estate, it was like, it doesn't take long in terms of looking at deals that are listed on the MLS before you're like, well, none of these make any sense. Yeah. And after a while, you're like, well, why am I wasting time looking at the 40th deal that hits the MLS that goes under contract at a price that I don't understand how anybody's making money? And I can understand, and even if I do understand how they're making money, that doesn't work for where I'm at. Like, I don't have a high income earning job or a business to go plow money into real estate where I have this other income source. I was like, I have to buy killer deals or else I hit a roadblock because I can't pull my money out and then everything stops. Yeah. So it's like, that's the one thing that I have to solve for. And then so I knew that very early. Like before I even did the first one, I was like, I got to solve for that piece of it. Yeah. And then after that, it was just a whole bunch of, I was like, now that I've identified that is what I have to figure out. It was just spending all my time getting educated on doing that, right? Where it was, I go and take all the house flippers in my market out to lunch and just ask them how they were doing it, right? And I started networking a ton with all the wholesalers, and send me all the multifamily stuff you have that doesn't work for your buyer list. Got very, very intentional with like direct mail, calling and emailing. And New Hampshire was an interesting market still is an interesting market where there's a ton of transparency behind corporate filings. If a guy goes and makes an LLC to go buy a property and the owner is the one who made the LLC, not an attorney, his email, he has to list his email. Everybody uses their best email when they're doing legal stuff, right? So I had the emails for all of the people that own properties outside of the people that hired an attorney to make their LLC. But for what I was pursuing, which was 3 to 10 unit deals, I was getting in their email inbox with and nobody else was doing this. Like 2016 to 2020, now way more people do this. Yeah. But 7, 8, 9 years ago, everybody, like, that wasn't really a thing yet, or at least as widely understood as, because think about how much content and podcasts and YouTube videos has taken off over the last 8, 9 years. Yeah. So for me, I was like, and I think I was, one, it was like I pulled my head down, never really picked it back up, which the pros were I was making a lot of progress pretty quickly. Mm-hmm. Cons being I didn't stop and say, hey, maybe you can go buy a 20 unit deal doing the same approach. Like it never even occurred to me to go after larger deals. Yeah. Because I was so like, I don't want partners. I don't want investors. Like I don't want to have to answer to anybody.
I think to a degree, you kind of have to have that little, I'm locked in. I've learned what that phrase is lately. I'm locked in. I'm no distractions. Like this is the only thing I'm going to commit to every single day.
Yeah. And that was very much what I did. And it was funny. I was like 2 years out of UNH and I was going back to like a lot of the internship programs at UNH, and I was like hiring interns. UNH, University of New Hampshire, that's where I went to college. But I was like going back to the college I graduated from and like hiring interns from school who like through the internship programs for like $500, $1,000 a semester, and then I was just giving them my playbook. So I had people just going out there and just hunting deals, and I was just sharing a percentage of the deal if they found it, and that was just more gas on the fire. So, and the reality is like early on when you have a great deal, like all of your options open up, right? You can flip it, you can assign it, you can buy it, or you can go and partner out with somebody on it. It's a lot easier to partner. And I probably had a couple people early on tell me the same thing, where it's just like, just go buy great deals and everything will just work itself out. Yeah. So that became really the focus. But I think the short answer to your question is there's probably something a little innate, just in terms of my own personality type. But the other piece of it was like, it was very clear that was what I had to do, or else I was going to go buy it. If the risk was like, I buy a little too much for a deal, I can't refi my money out. Yeah. Well, now I can't do any deals.
Then your whole equation to like creating wealth stops.
I was like, well, now I'm going to sit in my hands and let time, put that money back in my pocket through appreciation and all of that. Or, and I had the option to go to assign stuff and do that. But like my goal very early on was like, I want to try to hold and buy as much stuff and control it as I can instead of like assigning deals. But in any event, I think it just became clear that had to be the process moving forward early on.
And that's never going to change. The development of a skill set of being able to source a home run deal, whatever that's defined as for each listener, that will never go away, ever. Something that people...
No, I think it's the most valuable
Nobody
skill.
can take that skill set away. Like, I can't go into your head and say, okay, I need you to forget everything on how you find these sellers that have deals. You have a deal under contract that you're raising money for right this second. That was seller finance, right? Direct to seller?
Well, so not seller finance. We have a bank on that one, but it was direct to seller. Yeah. From a mail piece. Been mailing the guy for 3 years, and finally he goes, all right, man, I'm ready to sell it.
How big is it?
72 units, so $15 million deal.
That's insane.
$5 million equity raise from a mail piece. And that was a little special one where I was saying, so we have a very small portion of our list, which is like the dream list is what we call it, right? Like the stuff that's right in the area that we want to buy, right by all the other properties we own and manage, right size from a deal size standpoint, ownership of or long-term ownership, 10 plus year ownership, where it's like, this is exactly who we want to talk to.
Yep.
And we send certified mail to that list. So we spend like $6 to $8 per mailer to that list, but like, the open rate's 100%. Because somebody gets certified mail, they're like, well, it's not important. Yeah. So I hit that guy with a few certified mail pieces, and he's a funny guy. It was a guy and his partner who've owned it for 26 years. Yeah. And they were coming up on fully depreciating the whole thing, and that's why they're looking to sell it. Yeah. They're like, it's time for us to sell and move on and whatever. And he's like, we always joked like it was a psychopath who keeps sending us FedEx envelopes of certified mail.
Really?
Yeah.
And you got to be different. You got to stand out.
Yeah. And it's like, and so I have a conversation with a lot of people. I've told this story to other people who are like, and they're like, doesn't this feel like a waste of money? I probably spent like $500 on mailers to them. And I was like, no, because this deal, even just the acquisition fee, let alone the promote, pays for our direct mail for the next 40 years. Yeah. Like it's so, it all works out. But
very cool. Yeah. What's a very quick, like couple minutes, everybody's listening, they hear this specific part, they're like, okay, I need to go learn how to do off-market deal stuff. I know you have a little bit of the education. Where would you recommend people starting? Because unless you have the high-income job or you're in the private equity world and you're like, okay, I'm going to go syndicate $50 million of deals, and you're like doing it, most people, like the entry point is either find a great deal or raise some money for somebody else's deal.
Yep.
What would you best recommend for people if they wanted to take a look at sourcing off-market stuff?
I think very simple kind of first few steps, right? You got to have your acquisition criteria like very clearly defined and nailed down. And that's where you want to buy deals, the size of deals that you want to buy, and then the types of deals that you want to buy. Are you looking for heavy value add? Are you looking for stabilized stuff? What city, what county, what state, whatever it is, is it 5 to 20 units? Is it 20 to 100? Get all that figured out, because then you got to take all that information. You got to go buy a data list. Reonomy, CoStar, List Source, big three. Go buy a data list of, location, types of property, filter based on some metric that narrows it down and increases the likelihood the people you're chatting with want to sell, which is in our business, it's like, no sales in the last 5 years is like the easiest way to do that.
Yep.
Acquisition criteria, data list. Now you got to pick a channel, right? An approach. Going to depend on people's time availability, their budget, right? Obviously, you have two roads. It's marketing or prospecting.
Yep.
Marketing, you're trading dollars for leads, and then prospecting, you're trading your time for leads, more or less.
Yeah.
So marketing being like direct mail. I'm going to go spend $500 on 500 mail pieces, and or I'm going to spend the time to do them myself, but you still got to pay for the postage.
Yeah.
That all that goes out. You're going to get calls from people who are interested, right? Prospecting being, I got their phone numbers, I got their email. I'm going to call them up. Maybe I'll text them. Maybe I'll email them.
Yep.
Whatever. Pick an approach that like works for your budget and your time.
Yep.
With the knowledge that especially in multifamily, right? Single family, a little less so because it's a little bit more transactional. You might be able to send one mail piece and catch Aunt Sally at the right time because she inherited whoever's house and she might sell it. But multifamily, especially as you size up in terms of the deals that you're pursuing, more sophisticated ownership, less financial motivation to sell, right? They're not typically dealing with the foreclosures or whatever. And those deals just trade less often. Like it's a bit of a longer sales cycle. So if you're going to send mail, you got to be comfortable sending at least 5 rounds of mail. And for me, we send every quarter. So you got to be comfortable at least 1+ years worth of mail that you should be sending out. If you're calling, you should be comfortable calling your list every month or couple months for a year. If you're same thing, right? You got to have a very long-term vision. So whatever strategy you're picking, make sure that there's staying power there. And then I think it's easiest. You pick one channel, whether it's mail, and you layer in, or whatever it might be, one channel, and you layer in a second. A lot of investors kind of do some half-assed direct-to-seller stuff through one channel without consistency. Like, you want to not be one of those people. Not a lot of people pick 2 channels and do it consistently. Hardly anybody picks 3 and doesn't consistently. So at least you want to be doing 2.
Yeah.
So let's say you're going to send mail and you send it on January 1st or whatever. A few weeks later, go through and email the list or text the list or call the list and say, hey, did you get my mail piece? I'm so-and-so. Well, this is what we buy. We want to talk to you about your property. And then all of the fundamental objective in doing all of this is not to buy deals. And I think it's a subtle mindset shift, but it's just to network with other people that own stuff. If you don't want to sell, that's totally fine. We just love to meet another investor in the marketplace. Like, put that copy in a direct mail, say that if you're chatting with someone over the phone, put it in an email. And your goal is to just develop some level of a relationship with a seller. And the topic of selling their property is assumed in the fact that you're reaching out. It doesn't have to be the only thing you're talking about. Oh, when did you buy it? Are you looking to buy more? What are you kind of struggling with? Can I introduce you to any vendor? Like, networking, as you would if you met some guy at a real estate meetup. And every time you have a conversation with someone, move them into some kind of a CRM, HubSpot or Zoho, a couple of free options. Follow up every however many months or weeks in between that conversation makes sense based on that conversation. And if you do that over a year, you're going to do deals, right? I mean, that's just going to happen, assuming that you don't screw up along the way or you have some wildly unrealistic pricing, where you're like, I want to buy everything at half off. Okay, well, you may not do a deal, and that's something you should be okay with. But assuming you're realistic in terms of what you want to pay and all that, just expanding your time horizon and just making that part of your routine from a sourcing standpoint is going to bring deals in the door. But it's really just the fundamentals get you 80% of the way there. And the last 20% is, maybe you're kind of doing some things from a messaging standpoint, or like the certified mail like I'm talking about, but it's just doing the fundamentals over a long period of time. Yeah. And then you have those conversations.
Thank you for that. And I'm pretty sure everybody will thank you as well for actually going over resources and tangible steps. That's something I've always picked up from, I'm studying you and your content, what you do, and you always give tangible, like, hey, it's not easy, but here are the steps if you want to actually go do it. And then that serves as the barrier. It's like, hey, I actually did what you did, and I bought a deal because of it. Thank you. So, all right, now I want to move into the fun stuff, which is deals. So how do you define a home run deal for you today? And then what was a home run deal for you when you first started? Because I want to see how that has evolutionized, I guess is the right word. Because I'm sure the home run deal for you today isn't the exact same home run deal as it was when you first started.
Yeah, they have changed a little bit. There's a lot of overlap in that Venn diagram, so to speak. But I think early on, what I described as a home run deal was, it's funny thinking back to what I was even looking for. It was more like I kind of had a sense of what I wanted to buy. And
because you went from an individual, it's like, okay, I want to make money.
Yeah.
And then you're like, okay, now we have a company, I have people on my payroll, and then we also have investors to watch out for.
Yeah.
The buy box and the risk tolerance is probably much different than the individual that wants to pick up 100 or whatever the money that you're looking for over here is. That's why I asked the question.
It's a good point. Yeah. And I think early on, right, kind of the rough criteria for the first few years was like 2 to 10 unit deals, right? So size wise, that's what we were looking for. It was very specific to this one little area in Manchester, New Hampshire for, an hour north of Boston. Just head up Route 93, an hour north of Boston. It's the biggest city in New Hampshire, but it's 125,000 people, which makes it a pretty small city in general. But there was like an area within Manchester that was, it's primarily C-class housing. Everything, the vast majority of the housing in that area is early 1900s built. Wow. The vast majority of what we buy in our business is early 1900s built. Yeah. That's just the predominant year built of the housing stock in all of New England, whether it's Massachusetts or New Hampshire or Connecticut or wherever. So it's 2 to 10 unit deals, and it was sellers who were very mom and pop, very unsophisticated with some serious level of distress, whether it was like tenants who were just totally delinquent and they're working through an eviction process, buildings that were in rough shape from a construction standpoint, a lot of deferred maintenance, deferred CapEx, maybe some other type of motivation that's layered on top, whether it's lifestyle, I want to retire, I want to go somewhere. Maybe there's some level of financial motivation, right? Operational distress being we have tenants who are not paying. Financial being, well, that's now resulting in we're having a difficult time paying our mortgage, what have you. So we were looking for like pretty heavy value add stuff. And really that was because I knew that was the avenue to secure like the biggest discount. I was like, I'm
50 or 60 cents on the dollar. I got to step.
I can be all in on my costs for this thing at 70, 75%, which is, I got plenty of margin there to pull my equity out.
Yep.
Now, as the years have passed and as we started raising money for our deals, the seller profile is still very similar. Long-term owner, somewhat unsophisticated, somebody who's motivated by maybe some lifestyle motivation. They want to retire. Maybe they want to get into a different asset class. Like they're sick of multifamily. They want to sell it and go buy a strip mall or something with like less management requirements. Maybe it's a couple of partners. One's like, I want to hold on to it. The other one's like, I want to sell. And they're like, screw it, we'll sell it type of thing. But managerially, and then from a physical construction standpoint, that's where there is a lot of overlap where we're still looking for mom and pop owned properties where there's a lot of month-to-month tenants and there's some level of deferred maintenance. Now, if I were to define like what the perfect deal is, it's Class B or C plus, right? We want to get away from kind of the true Class C stuff. We're getting into an area higher median income, lower vacancy, higher average tenant credit score. Class B just being an easy way to describe that, right? Class B, minimal deferred maintenance, but massive issues with management. So we want the bulk of our returns to come from us going in there and optimizing the management, whether that's we're going to collect more rent, charge more rent, bring some of the legacy folks closer to market rent, start charging pet fees, parking fees, storage fees. Maybe the expense out of the P&L is a little out of whack and we can save money there. But we want the vast majority of how we're being compensated in terms of the value add showing on the NOI to come through management upgrades versus CapEx. Like the deal that we briefly talked about, the one that we have in the contract right now, buildings are in great shape, great roofs, great heating systems, great windows, good siding. The units are in pretty good shape. The sellers have taken good care of it, but they've let rents lag behind because they don't have to keep them in the market. They don't allow pets, which is crazy. So not only are they not charging pet fees, they just don't even allow it in general when it's a perfect property for that. Bunch of storage units that they're not charging for, massive, beautiful 3-stall garage on the property that they just have a couple of cars and that would rent for, $1,500 a month. All of these areas where we can add value that don't require us to spend a lot of money renovating units or fixing the roofs or doing whatever. So the higher percentage of returns that we can generate from management versus CapEx, the better, because it's lower from a risk adjusted standpoint, right? Anytime money's going out the door, you run the risk of misunderwriting it or going over budget or something happening along the way that you didn't expect. So that's our, holy grail deal. That's kind of what we call that in our business is like Class B. We're going to get paid for our knowledge, really, and what we can do on the management side over CapEx, and one that's located in an area that has, above that market's average or above that market's median income and median rents. Got it. So we just have a higher quality tenant base. And if we can find a deal that's got kind of a lot of those things at play, then that's one that we're really going to go aggressively pursue, both in terms of like the time we spend on it, but also what we're willing to pay as a percentage of that deal's market value, so to speak, right? Where it's like, we're in a heavy value add. We got to buy that thing at a really healthy price to compensate us. Whereas if it's one of the deals, a deal that I'm talking about that checks all those boxes, we're willing to get a little bit more aggressive on pricing because we know that it carries less risk than something that's a little
It's
heavy.
Funny you say all that because in our rent stack, in our underwriting model, we have average in place and then seller's proven on his rent roll. And then we have a column that says upside without any renovations or any CapEx going out. It's just an expense change. And then we have the final tab. It's like, all right, we got to spend money to get this return. And we break it out from that risk profile. I'd rather take a 15 IRR here with all of the upside and the management upside versus an 18 or a 19 and all of it's baked in. We got to go spend 10 or 15 grand a unit.
100%. Yeah. It's like, we think about CapEx as a percentage of the purchase price a lot, so for example, this $15 million deal, we have a $575,000 CapEx budget. Like it's basically 4 or 5K a unit. Because the place is in great shape. There's only like 4 or 5 units that need a full renovation. Everything else is great. It's just, we're bringing rents to market and it's like a very straightforward business plan. The other thing, which I think I kind of mentioned, but I skipped over quickly, is we like a lot of month-to-month residents. Sometimes that scares a bank. Sometimes that scares a more risk-averse investor because you don't have that guarantee of
Yeah,
income or whatever.
12 months from now, the same tenant paying the same amount.
Yeah, we love it if we had a lot of folks who are month to month, because we can get in there and start. We know where we can take that rent roll in 90 days, 120 days, and we can just really start adding value quickly.
Yeah,
and get into our business plan like right away, which is the case in this particular property. But for example, a deal that carries maybe a 2% of the purchase price CapEx budget, which would be like really small, that's 20 grand on $1 million deal.
Yeah.
Maybe that's just you're fixing some stuff in the common area. You're not even doing anything in the units, versus a deal that carries a 10% CapEx budget, or even higher, 15%, whatever it may be. Like, that's kind of the critical data point to where that should inform the returns that you're seeking. And I think a lot of folks who are out there, if you're looking for like light, moderate, value add multifamily deals, like you'll start to see your per unit CapEx come in kind of around a range on a lot of the deals you look at, and then you can kind of throw a percentage on it. But that's a big number in our business. It's like if we're at a 10, if this is a deal that carries a 10% CapEx budget of the purchase price versus 15, then we're going to start to underwrite that a little bit differently in terms of the projected returns we want to achieve. And we've started to kind of like define that a little bit more in our business, versus this just feels like it's a safer deal, so we're okay at a 15 on this one, and this one feels a little bit more risky, so we want to underwrite to a 17 or something like that.
Yeah, makes sense. All right, so how important is speed? You mentioned it right here with the month-to-months, and I want to touch on it because for the operator side of it, there's very few people online that are actually operators, so thank you for being one of them. How important is the speed component in executing your business plan? Because that correlates into more IRR in a quicker period of time for the investors, which entails more investment, more deals, all of it, as a really big factor. How important has it been for you in your career?
Yeah, speed's huge. I mean, if you're looking at IRR in terms of net to LP returns, like speed in the execution of the business plan and getting to a capital event, whether it's a refi or a sale, is such a massive determinant of what that is, as you mentioned, right? So obviously we want to get things done quickly so that all the benefits trickle down to our LPs. Now, if it's me personally and I'm just doing a deal myself, it's the same thing, but it's just my own capital, right?
Yeah.
So, which is, that's a speed being a big reason why we like those month-to-month folks. Our goal is to spend all of our money on our common areas, exterior, or systems CapEx, like within the first 90 days of closing the deal.
Really?
As much as within reason, right? And usually we can do that because we don't have to bug tenants, or we don't have to vacate units in order to do all of that. But when you compress the timeline that it takes to do all of the things that you want to do in your business plan, you're like, in that first year, I think we're going to go do the roofs. I think we're going to paint the common area. Maybe we're going to try and stripe the parking lot and do all of that. Like, the faster you get that done, the faster the benefits of that trickle down into the rents that you can achieve in the community. I think one of, now I'm getting deep in the weeds, but I think something that a lot of folks who operate deals are plagued by when they close a deal is there are these different components of the property that we could do this year, but we might get another couple years of life out of them. Like, the heating systems are 25 years old, but they still work.
Yeah.
So they might, should we hang on and wait until they fail? Like, the roofs are, I don't know, they're 20 years old. They got a 25-year lifespan. They kind of look crappy, but we could probably get a few more years out of them. Just do it all up front, because it trickles down, the benefits trickle down to all the residents, and you start to, and it makes it easier for you to outperform your rent projections. Also, what it does is it allows you to manage your cash so much easier, because you don't have these ticking time bombs of these big CapEx, these big line items on your CapEx budget coming down the pipeline a year, 2 years in the future.
Yep.
So what we want to do is we want to get all of our money out the door, like take care of everything that we got to do. Then we get into the interiors, and then we're starting to rent, and we just know that that what we're doing here is now we're renting a complete product, which makes it a lot easier to just communicate to tenants, like, we just did all of this stuff, and this is why it trickles down to this asking rent. And then when we refi, we know we've done all of our CapEx, so we don't have any of this stuff kind of lingering behind us like the boogeyman. Like, we're going to have to go do the roofs next year because we thought we could squeeze another year out of them, and now we have to like manage the cash and distribute some to investors, but we got to hold back a bunch. So it helps from a cash management standpoint. And I think that's actually a really under-discussed component of that, especially when you're raising LP dollars, because managing your reserve account and managing what you distribute versus what you hold back is a really fine line. So that makes that whole process easier. And then obviously speed trickles down to absolute returns, which is another component to that.
Yeah, man. Well, thank you. All right. Completely moving to a different direction. We've talked about this a couple times, and I think we're both in complete agreement. I worked at Grants for 3 years, raised $100 million there, went through 19 institutional transactions. I've syndicated $50 million of deals, raised $7 million of equity from doing that since quitting. I am not the big fan for most people to start in the syndication business. I think most people should start in 5 to 10 or 10 to 15 or whatever comfort they can find in a similar, you call it small deal, in their backyard or somebody else's backyard. Would you agree that if you're just starting out in real estate, maybe you're flipping homes and you're looking to go into multifamily, you see a bunch of people online that pound their chest and say you need to raise money, be a syndicator. What would your advice be to them on getting started? Is it become a syndicator day one, raise a bunch of money, become the next Steve Schwarzman? Or is it, hey, it's not the sexiest thing in the world. Start small, start with something that you can actually get into. Because I think the quantification, I wish we could do the whiteboard. You can make more money in those smaller deals than you can doing the bigger syndications. I just want to get your input on it.
Yeah, and as you know, I have pretty strong opinions on this topic. I think there's a couple lanes I want to go down. First being what we do, or what you do when you get into the business.
Yep.
I think it depends on how you want to participate in the business, first of all. And the real quick way to describe that is if you're somebody who wants to raise money for deals and you're not going to be a deal finder and operator, well, it doesn't really matter the deal size. You can go raise for a 200-unit deal or a 20-unit deal. You're out there trying to raise money. Oftentimes, it's a little easier to raise for somebody's deal who's established, who's doing a bigger deal because you're leveraging their track record. So not speaking to those folks because I think that's a little different, but speaking to the people that want to go find the deals and buy the real estate, whether they're the ones who are raising the money for their own deal or they're going to use their own capital to buy their deal, what have you. You got to start small. I don't really understand the approach of so-and-so says I got to go big, so now I'm going to go wait to do my first deal until I find a big deal, because it's infinitely harder to do big deals than it is to do small deals. It's not even comparable, frankly. And also early on, and I'll talk about the financial piece of it in a second, but you just have to build momentum. You got to stack wins. You got to make progress, right? And waiting to do, let's call it a 50-unit deal, which I'll use in an example, is the time between you wanting to get into real estate and closing a 50-unit deal is that time horizon is so much longer than you just going and buying a 5-unit deal.
Yep. With,
whether it's your own money or it's you and a friend's money or one investor.
One person for 25 or 50 grand.
Exactly. And then you go through the transaction process, you go through the process of doing due diligence, you go through the process of vetting a property management company, you go through the process of going through the lending. The knowledge you gain on doing deal one is so significant. And even if you're, in a mastermind group or a community, or you're taking educational courses or whatever, nothing's going to prepare you for doing that, period. You just have to do it. So you might as well just go do it. And doing it on a small deal gets you so much farther, because the next one, it makes it so much easier to go do the big deal after that if you do want to go jump into that deal size. And then financially speaking, right, that's the other piece of it.
This is what I think most people don't see. They see,
I can get specific on the money.
Well, no, I want to. Okay. I want to. People see, for instance, our asset management fees are 120 or 130 grand a year, reoccurring. We've syndicated 50 million. We've raised $7 million of LP equity. The acquisition fees, a couple hundred. It's a bit to syndicate $50 million, pretty hard thing. And in relation to you buying a 10-unit deal with your own cash, executing the business plan, and going full cycle in a year, you'll pick up the same 150 or 200 grand that we picked up doing this big syndication model. Yep. I want to get that deep and quantify it, because I don't think people see it.
So it's 5 unit versus 50 units.
Yep.
Let's just say, whoever's listening, you can go out there and buy a 5-unit yourself, or you want to go out there and raise money and buy a 50 unit. So 100 grand a unit for both deals. Let's just say they're valued the same, right? So the 5-unit being $500,000, right? And then the 50-unit deal being $5 million. 5-unit deal, let's say you go out there, you buy for 500, you pay market. We're going to leave closing costs out of this because we want to simplify it. You got to put 20% down, and you go and get a credit union to lend you the money, a bank, whatever. You put down 100 grand. And now you own a 5-unit property that's worth 500 grand. Conversely, right, on a 50-unit deal, one, you got to go out there and you got to find a 50-unit deal. There's less of them to do. They're harder to find, and
you got to
more challenging.
You got to beat people like us who will compete on it and have a better relationship.
100%. Yeah. And that deal is going to take $1 million to close. Same bank, they're going to give you 80% LTV on that deal. So you need $1 million. Let's say you got your own 100 grand to invest. That's your 10% co-invest. You're going to, as an LP, invest 100 grand. And you go out there and you got to go raise 900 grand. Let's say, you have to go out there, you're probably gonna have to partner with someone to help sign on the loan so that you can get the loan closed, because you need a balance sheet that's equivalent to the loan amount or more.
Yep.
You need somebody who has liquidity, 9 months plus of post-closing liquidity. Probably need someone to help you run that deal. You probably don't have the skill set to go and run a 50-unit deal. Now, let's say you got $1 million in equity, 70-30 split on that, a 70-30 profit split, right? Very standard syndication terms. We'll just leave the preferred return out of it for ease of communication. 70-30. And of that 30, let's just say you keep a third of it, right? In a best case scenario, you probably
10 out of 30.
Say it again.
So they own
exactly
10 out of the 30. Yep.
Exactly. So you got 10% of the upside in this deal.
Yep.
Versus having 100% ownership in this 5-unit deal.
Yep.
Fast forward a few years. Values go up in this marketplace, and now they're each worth $120,000 a unit, right? So now your 5-unit deal is worth $600,000, and the 50-unit deal is worth $6 million.
Yep.
So you sell your 5-unit, again, closing costs out of it, you make $100,000.
Yep.
All right, great. So you invested 100, you made 100, perfect. 50-unit deal, you sell it for 6, you pay off the bank's debt of 4, you return that $1 million in equity to your LPs, you get $1 million in profit.
Yep.
Split 70-30. 70% goes to your LPs. They're happy, they get a good return. Now you have $300,000 in profit. Now you have to slice that up amongst the partners that we just talked about, right? You're only getting a third of that. You're only getting 10% of the upside. You make $100,000. You make the same amount of money, and it's 10 times as hard to do the 50-unit deal.
Yeah.
You have to find a good 50-unit deal. You have to convince the broker to communicate to the seller to take your offer. Or if you're going direct to seller, you're going to knock on, have a lot of conversations to find a 50-unit deal.
Yep.
You got to put together the capital, right? And let's say you brought someone in to raise that 900. Well, you got to give them a percentage of the upside. Yep. Let's say you raise all the money. Now, let's say you got 2/3 of the GP. You got 20%. Okay, cool. You make $200,000. All right. So you made some money there. And I will say that the part of this analysis that is left out in my quick little example here is any acquisition fee that you earn, any asset management fees that you earn. 2% acquisition fee on a $5 million deal is $100,000. Again, you're splitting that 3 ways. So you make $30,000 there. Cool. So you make $130,000, whatever it might be. But long story short, the point that I'm trying to get at, and I think, that we're talking about in general here, is if you, even with the acquisition fee, even with making some money on the promote, even with, your co-invest making some money as well, maybe you make twice as much money as you do on the 5-unit deal, but it's 5 to 10 times as much work to do it. And that's the big takeaway here. And the last thing I'm going to mention as it relates to doing a smaller deal, whether it's 5 units or 3 units or 8 units or whatever, it's so much easier to go and buy that 5-unit property that's worth $500,000 for $400,000, $420,000, $450,000, where you close with a lot of equity at closing. It's much easier to find a discounted opportunity in that size range. And the last point is, you're receiving the cash flow on your 5-unit deal that you just bought with your own money. Any syndicated deal typically has a preferred return. All of the cash flow from that deal is going to the LPs. You're not seeing any cash flow as a GP. And that's, I think, one of the biggest misunderstood components of raising money and doing deals. Was just at a conference this week, and as I mentioned to you, everybody there wants to do big deals. And it's like, the harsh reality is, okay, you can do that, but do the math. And then also accept the fact that you're not seeing cash flow as a GP. There's no cash flow as a GP outside of an asset management fee. And that could be meaningful to you depending on where you're at, but you're not seeing any cash flow from operations until you do a really large refi and return a very large chunk of investor capital. Which 2-3 years down the line, probably on really any deal, really you're being compensated when you sell. That's fundamentally when you make the money. Versus you can build a portfolio of smaller properties along the way and actually generate cash flow.
I have a very strong agreement with the statement. And the reason I say it is because I'm a big numbers guy. I'm a big probability guy. So what's the probability of somebody that's listening, they're in a job, or they want to jump in the multifamily, they're doing the single family home. What is the highest probability of success for them jumping in the multifamily as a whole? You have different options. You can go down the small 5 to 10 off market, or you just have other people bring you deals, or you can go down the syndication route. I see even myself being at grants. It's like the only thing I wanted to do was big deals. And the more people that we have in our community, I'm like, hold on a second, let's look at performance. Let's look at how many LOIs that went out, what size deals were we going out. Interesting. We actually see more deals actually get awarded and close on the 10s, the 8s, the 12s, the 16s than we do the 172 unit. But all you hear about is this $25 million deal is 172 units. Nobody talks about carried interest and how much is retained.
No, and I think this is it's a bit of a sidetrack, but I'll kind of bring it back. Like,
we're weaving.
Yeah.
Have you seen?
Yes, yeah. I'll bring it back.
Okay.
I'll do it faster than Trump did at Joe Rogan's pod. But you have kind of what we've been talking about is small deals, which are, let's assign 5 to 20 units to that size range, what have you, right? And you can, let's say those are deals that you can do yourself, maybe with a joint venture partner, something like that, but you own a very large percentage of that equity. Then you have what I call the messy middle, where it's like 20 to 100 units. And I'm out here raising money for those deals and doing those deals. So take it from me, I know the economics of those quite well. And unless you're doing those at like scale, in terms of you're doing a couple hundred units a year, which is kind of the volume we do with those types of deals. And so we're doing a higher volume of deals approach, but individually on those deals, the promotes and the fees aren't that significant. That's what I call the messy middle. Let's just call it $15 million plus in deal size. 100 units in Indiana is a lot different than 100 units in Miami, but like, casually speaking, $15 million plus in deal size. When you get to that large deal size, obviously you're making money via a promote, but it's much easier to build a platform around doing those deals because the fees are much more meaningful.
Yeah.
So the messy middle, you're not really making that much money on fees, and you're not really making that much money in your promote. Relatively speaking, a lot of money is different to different people, but it's harder to build out a platform where you're going out there and you're doing 8 pref 70-30 splits on these $3, $5, $6 million deals unless you do a lot of them.
Yep.
So it's much easier to kind of pick a lane. So for me, early I picked my lane of doing these small deals that I own, and I still do those now. Like I'm going to close on a 7-unit deal that's $1 million in a couple of weeks that I own, or that I'll just be doing personally. And for me, those deals make as much money, nominally speaking, as me being a sole GP on a $4 million deal. When you look at basically the same analysis I just did.
Yeah.
The reason that we do those deals that are kind of in that messy middle is we find them. It's like we're finding good deals. So what are we going to do? Not buy them? So that's one. 2 is it allows us to build out our infrastructure a little bit more easily in terms of the property management company, more units under the roof of the management company allows us to hire and make that business a little less fragile. It allows us to continually transact in the marketplace, get our name out there, etc. I don't have the money to do them myself, so really the only way to get them closed is to raise them.
Yep.
But they're not. But the economics are out of whack until you get to, again, a much larger deal size where now the fees are a really large absolute percentage return as a GP.
Yeah.
So when you're early, you should try to almost pick one side or the other. And obviously, my opinion is pick the smaller stuff.
Yep.
Do some deals yourself that are smaller. If you're going to raise for a deal in the messy middle, understand that the economics may be out of whack, but you're doing it for other reasons. And now where I'm at in my business is trying to mitigate the amount of deals that I'm raising for in the middle. Either do deals myself or with a partner or two, not syndicate those deals in the middle and only syndicate deals on the larger side. Because that's what economically makes sense for our business.
Well, thank you for breaking it down. I'm telling you, I really do think people are going to enjoy it. All right. So let's wrap it up with what does the next 5 years look like for you guys? I guess 2 things. What's the future look like? And then crystal ball 25 predictions. That's how we'll wrap it up.
Got it. So start with the crystal ball, and then I'll talk about what we're trying to do over the next 5 years. One of the really common, I guess, talking points right now, for lack of a better way to put it, data points that a lot of people in multifamily are tracking is supply falling off a cliff.
1 million units?
Yeah. We own, we had a 48 unit in Florida. We're up to about 100 units and change in Florida between a few deals. We sold a couple of them, did well, and we still have a 48 unit. And then we have, a few hundred units in a very concentrated area in New Hampshire. And we got up to more than that, and we've been selling some to try to put some in cash to kind of take advantage of where we're going. Those are two polar opposite markets, but speaking geographically, you have the Southeast, Southwest, Northeast, kind of Northwest, West Coast. And the high level comparison being supply constrained versus not supply constrained. Ton of people moving to Florida, ton of people moving to Arizona, ton of people moving to Texas, but they're building the crap out of new development, and they added all of this new supply.
Yep.
So we have this 48 unit in Bartow. That's where we own it. And we're keeping the units full. We're doing a good job, but supply is really something that we have to contend with because there's just been a lot of supply added to that market. There's been no supply added to the New Hampshire marketplace.
Really?
So in 22, 23, 24, when a lot of rents were going the other way and throughout the country, they were going up. We're still seeing rent growth. Supply falling off a cliff as a result of nobody starting any deals this year because construction costs are still high, rents have flatlined in a lot of markets, interest rates have been high, it's harder to pencil new development. That falling off a cliff, I think, is going to be a nice tailwind for people that own existing deals, especially for the folks who already own stuff in supply-constrained markets where there wasn't a lot of supply being added anyways.
Yeah.
And then for the folks who are in like in Austin, Texas, where like they're just trying to hold on, just keep their buildings full, like it's going to help those folks. So I think that's number one. And I think it allows you to be a little bit more precise with projecting rent growth.
Yep.
We're not one to go into an underwriting model and do like 4.5%, 5% rent growth throughout a whole PL. I think that's a little irresponsible. Every deal will pencil out if you do that.
Yeah.
But if you've historically been at 2.5%, maybe you could try 3.25%, something like that, right? A little bit more nominal growth in the first 2 years of your hold period if you're doing deals today. Other components of this, I don't really see a world in which single family home pricing comes down because it's the same dynamic, right? We're not adding new single family homes in the vast majority of the markets for the same reasons. It's expensive to build, interest rates are high. And it's really hard for first time home buyers to go out there and buy a property. So I think percentage of the population that is renting will continue to increase as a percentage of the overall population. And again, that's going to hit some markets more so than others. In a market like New Hampshire, for example, where median home prices are $550, $600 in a lot of the markets that we buy in, it's much higher than the national average.
Yeah,
you got to make $200,000 a year to go and afford a mortgage payment on a starter home, right? And even then, your alternative is in terms of what you could rent for is so much cheaper. So I think we're going to continue retaining a lot of residents. I don't really see a world in which more residents convert to home buyers over the next couple of years. That's not something that we're predicting. I think lastly, and this is less about like economics and in terms of like pricing and stuff like that. And this is something I've noticed over the last couple of years, as I'm sure you have. I mean, like groups like the Deal Room, right, are impacting the marketplace in a similar way, where the average knowledge of somebody who's getting into this game is just so much higher year after year. It's almost like hard to be a new investor nowadays and not like at least get into the business without some hold on the process, right?
Oh, yeah.
Some knowledge of the process. Even just back in 2016, 17, it was a completely different landscape as it relates to really the only education online was like some YouTube videos and bigger pockets. And now there's specialized education depending on your strategy. There's 20 times as many podcasts.
Go look anywhere on your phone.
It's impossible to not get inundated with, let me show you how to do it, right?
Yeah.
So the new investors who are getting into the game now and the existing investors, the baseline skill set's much higher and it's just a much more competitive game.
Yeah.
Even if the market adjusts and pricing comes down or what have you, the average player is just better. Yeah. Like, especially for the younger generation of people, I'm a little older than you are, I think, but like I'm 30. So anybody who's like 22 to 35, like 18 to 35, there's no excuse for them to be bad at real estate investing because there's just so much content.
Yeah.
And I think that the mom and pop owned era of these deals is we're starting to slowly phase out of that, where like we're still buying properties from someone who's 65 who has no idea what they're doing. Yeah. Like they're not collecting rent. They're not using any property management software. Like those deals are going to be less abundant year after year, which is why in our business, I kind of feel that, right? It's like our marketing is a little less effective now than it was 2 years ago, much less effective than 4 years ago, way less effective than 6, 8 years ago. But there's still opportunity in doing so.
Yep.
And I think there always will be to an extent, right? There's always going to be a motivated seller. Yeah. But like the fruit is not as easy to pick off the bottom of the tree. You just have to climb it higher up. So we're pouring so much more resources into that, knowing that it's never going to be as easy as it is today to find deals, which I guess is a much more succinct way, I guess, of trying to say what I took a little bit longer to say. So that's a dynamic that we're noticing as well.
Yeah.
As for what we're doing, 5-year goals, I think a lot of people have a dream of owning a large platform that owns and manages thousands and thousands of units. Yeah. That used to be my goal in terms of New England and then other states throughout the country. I've since kind of the last couple of years, I've kind of refocused on what I envision being like ideal work-life balance, ideal day-to-day. I wake up and I'm going to go run a business. 1,500, a couple thousand units in a market like New Hampshire is a really large portfolio.
Yeah.
3,000 units throughout New England, being maybe it's New Hampshire, maybe it's southern Maine, maybe it's like northern Rhode Island, kind of hour north of Boston, hour south of Boston. That's a really, really large portfolio. That maybe is like a 5-year down the line objective is something that I'm thinking about. The challenge for us is we're vertically integrated, so we have to grow that business in conjunction with our portfolio. But really, like that is all a means to an end for me, which is I would, my whole North Star in this business is I want to own, 500 units of property that I own myself with moderate leverage. That's where the real money, all the
generational, something you can pass on.
All the wealthiest guys I know in real estate, like all the old timers in like Boston, all these guys who are worth, 9 figures plus. It's just a bunch of people who bought stuff themselves and they just and they just did it over a long time horizon, and maybe they syndicated along the way.
Yeah.
But the vast majority of their wealth was built in just deals that they personally own. In 1031 that 8 unit into a 20 unit. They had that for a few years. 20 unit into 30 units.
Yeah.
And for me, it's also an ideal because it's really hard. It's really stressful to raise money to manage a large business. We've probably raised $18 million now. We've got 100 investors in our deals. That's the most stressful part of the business, is that part of it. So it's like at some point when I'm 40, 45, 50, like having 500, 600 units or so that I'm the sole owner of, and I've phased out of some of the syndications.
Yep.
That's kind of my ideal long-term goal. Yeah.
Well, thank you for sharing that. So lifestyle, is it get super wealthy, give back, impact? Do you have any charities? You don't work all these hours and work really fucking hard finding all these deals. Do you have anything that you want to like touch on charity or something that you do to give back?
Yeah. So we actually, I sell a couple of small like educational programs. Mm-hmm. I know you're aware of that. Yep. We donate 5% of all the gross proceeds to a charity in New Hampshire called Families in Transition, which is basically an organization. They do public-private partnerships, privately funded with some public funding. And they basically create transitional homes for people coming out of homelessness, 90 day, 120 days. Big part of what they do is educate. There's a lot of education around personal finance. Yeah. So it's above and beyond just a pure shelter. It's educational as well as housing. So we donate 5% of the proceeds of that to that organization. And another byproduct, I mean, without going too deep down this road, but oftentimes the root cause of homelessness being drug addiction, challenges in my family as it relates to that. So part of that organization, they have an arm as well, which is more drug rehabilitation. So it's a charity that kind of serves both of those purposes. So everything that we do in our business, like educational wise, in terms of like selling some of our programs and stuff like that, that's a big component of it, is just 5% of gross proceeds. Yeah. We donate to those.
I asked the question because the impact part, like after you get to the you create wealth for yourself, then you build out a team, your staff, your investors, all that. It's like you get to the point where you have a lot of money, and then philanthropic approaches and like charity and giving back, and then the impact that you get from that.
I think oftentimes people, it's like, well, I'll do it at some point, but you never know when that some point is. Yeah. So the way that we kind of figured it out in our business was tying it to a component of our business, so that it scales over time. Yeah, that's awesome. And then, I mean, homelessness is like one of the biggest problems facing, I think, the country. I mean, different areas. Yeah. It's a different issue, depending on where you're at. But I think part of a challenge of doing a lot of C-class real estate investing is you see the other side of the people who are living in sometimes really challenging situations. And oftentimes they end up either coming from a homelessness situation, or they may be returning to one at some point in their life. Yeah. So getting involved at that level, it's like a little bit more directly adjacent to what we're doing in the core business anyways, which is nice. Cool, man.
Well, all right. I could probably sit here and talk for hours and hours and hours. So you're raising money for the deal right now. I'm not sure when this is going to air. When did it close?
Early December.
Okay.
Sometime mid-November, we may have a few slots open. Yeah. Reach out to me.
So you do a lot of podcasts. You have a couple of educational programs, which, by the way, you should, like, if you want to jump into the business and you're going to choose that one thing of like, what am I going to be? And you want to be the deal finder, 100% you need to hook up on Axel's stuff. I do not trust a lot of people. There are a lot of bad actors in this business, and Axel, I can say with confidence that I trust him and that you should grab at least some of this stuff, if not invest with him and learn from him. Where can people find you and like plug into what you're doing?
Mm-hmm. Well, first of all, I appreciate that. Second of all, Instagram is where I'm the most active, at Multifamily Wealth. And then the Multifamily Wealth Podcast is the podcast I host 1 to 2 episodes a week. I'm really feeling it. 2 episodes when there's a little bit more going on. It's 1 episode, but it's very, very tactical content associated with building a multifamily portfolio specifically for operators. Yeah. Like people that are finding deals and putting them together and getting those deals closed. Outside of that, Axel, AXEL at alignedrep.com. Cool. That's my email.
All right, ladies and gentlemen, that was an amazing episode. Axel, thank you so much for being here, and we will see you in the next one.